one of the most repeatable topics around a gold bull market has been that when the generalist investor begins to come into the precious metal space, that leadership changes from gold to silver. It would appear, Steve, that that's occurred. The silver price is greatly outpacing the gold price. You need to look at that chart and see if the silver market doesn't need a rest. It looks to me like the silver market does need a rest. Now, I'm not a silver buyer, I'm a gold buyer, but I am a silver stock buyer. And that chart gives me a lot of caution.
The precious metals market is once again forcing investors to think in terms of cycles, leadership, and timing, rather than headlines or short-term price moves. Gold and silver are behaving in ways that are historically familiar, yet psychologically difficult, especially as silver begins to outperform after years of underperformance. When leadership rotates inside a bull market, it often signals not exhaustion, but a transition into a more complex and potentially more profitable phase. Understanding where we are in that transition is far more important than reacting emotionally to price acceleration. Silver's recent strength has naturally reignited investor enthusiasm, but history shows that periods of sharp outperformance are often followed by consolidation rather than immediate continuation. This does not imply the end of the broader precious metals bull market. In fact, it often suggests the opposite. Temporary pauses allow markets to reset sentiment, rebuild positioning, and lay the groundwork for higher prices later in the cycle. The key is recognizing the difference between a healthy pause and a true top, especially as we look ahead into 2026 and beyond. Rick Rule, one of the most experienced and disciplined investors in the natural resource space, approaches this moment with characteristic restraint. Rather than chasing momentum, he focuses on value, behavior, and the signals that historically appear when markets become overheated. His analysis does not argue against higher silver prices over time. Instead, it emphasizes that markets rarely move in straight lines, and that short-term exhaustion can occur even within powerful secular uptrends. For investors, this distinction is critical. Rule also draws a sharp line between owning silver as a metal and owning silver equities. Mining stocks introduce layers of operational, jurisdictional, and capital allocation risk that metals themselves do not carry. As prices rise, those risks do not disappear. In many cases, they become more pronounced. Knowing when leverage works in your favor and when it begins to work against you is one of the defining skills of successful precious metals investing. Beyond silver and gold, Rule expands the discussion into energy markets, particularly oil, where supply constraints, underinvestment, and geopolitics are colliding in ways that most mainstream narratives fail to capture. The intersection between commodity scarcity, political incentives, and long-term capital neglect creates pressures that do not resolve quickly, and understanding these pressures adds an important macro layer to the precious metals thesis. If you value deep, cycle-aware analysis that cuts through market noise and focuses on long-term positioning rather than short-term emotion, make sure to like this video, subscribe to the channel, and stay with us as we break down Rick Rule's insights in detail.
What are some of your indicators of when it's time to let go of some of your silver equities? I mean, general indicators. Are you looking at gold to silver ratio? Are you looking at fervor in the streets? What are some of your indicators?
I would say fervor in the streets. I mean, understand that I'm not a trader per se. I construct very, very, very rough models around value. So price matters to me only as it differs from value. And the silver stocks that I had owned as a consequence of my belief in a move in the silver price, I have already sold. My reason to own the stock came and passed, and so I sold the stock. The reasons that I still own the rest of my silver portfolio is because I believe that there are circumstances individual to each company that will increase their value. So as an example, I own Pan American Silver. The increase that we've seen in the silver price makes their acquisition of Mag Silver more economic than it would have appeared at the time that they made the acquisition. You know, that was an acquisition that was predicated on $35 silver.
Yeah.
$60 silver rewards them more than $35 silver did. In Pan American Silver, I'm also attracted to it because they have now had, 5 or 6 quarters to begin to work their magic on the assets that they acquired from Yamana. And sure enough, they're beginning to get better operational performance at the same time that they're getting higher commodity prices. One could look at my holdings in the more speculative names, Vizsla Silver or Abra Silver. In both cases, I think that there is a lot of exploration upside in the company. In other words, I don't own them purely for leverage to silver. I own them for reasons interior, if you will, to the company. Ironically, in a rip-roaring silver market, there's probably more money to be made on the bullshit juniors that don't actually have silver or the very, very, very inefficient producers. Because as sentiment comes into that market, you can take up a $20 million market cap to a $100 million market cap for no fundamental more specific than a $500,000 financial public relations budget. That's not the way I trade. I'm very much a guy who invests, who buys and sells based on value or perceived value. And there's a lot of value and perceived value remaining in the high quality silver names, despite that parabolic silver chart.
And alarm bells in my head can't help but be going off. Is that misplaced, or am I accurate?
I think it is misplaced, Steve.
Okay.
Because only about 18% of silver supply comes from silver mines. The rest comes from recycling or as a byproduct of mining other materials like gold, copper, lead, and zinc. So to really get a feeling for what silver production looks like over the next 5 years, you have to pay attention to how much copper is going to get mined. And I think irrespective of what we do in the copper industry, we're going to have production declines in copper for the next 5 years, no matter what we do.
Yeah.
Which means that byproduct silver production is going to decline. Remember that as a copper miner, your production cost is effectively the cost of removing silver from the product stream. You have no mining cost because you paid for that in the gold account. The zinc price has been up, but it's still fairly flat. And I don't see any production increases coming in copper or lead or zinc for the next 5 years. In copper, I think it's more likely that we produce less over 5 years rather than more. And that should mean that byproduct silver supplies are lower, not higher, irrespective of the margin available on pure silver mines. When I look at the silver mines on the horizon that could be brought into production, I don't see many. Certainly the exploration success that, as an example, First Majestic has enjoyed both downhole at San Dimas, but also at Ermitaño, and the prospective joy that Pan American sees at La Colorado. You don't see a new Cannington or a new Juanicipio. You don't see that much silver on the horizon. The two places that you do see silver on the horizon, one would be the Pan American deposit in Guatemala, the name of which escapes me, which appears to have still pretty strong political challenges ahead of it. The second would be another silver deposit within Pan American in Argentina, which is similarly, at least at the state level, politically challenged. So I don't see a lot of impending supply from silver companies. And I don't see near-term supply increases from byproduct. That is to say, increases in the next 5 years.
Okay. Because most of silver comes from copper mines.
Comes as a byproduct. Copper, lead, zinc, and gold. You are going to see some production increases on the gold side, which should give you some increased byproduct silver. But I would suspect not enough to be worried about. I understand your concern perfectly around the incredible margins in the silver business, where the silver industry would increase their production if they could. I just don't see them being able to in the near term. And it's important to recognize, as I say, that less than 20% of primary silver supply comes from silver mines. The intention of silver miners is less important than the intention of recyclers, who are pretty close to maxed out, and gold, copper, lead, and zinc producers.
Picking up from Rule's discussion on silver equities, the core message is not about abandoning the sector, but about understanding why you own what you own. Rule is clear that price alone is not his primary decision driver. What matters is whether the original investment thesis remains intact. In cases where silver equities were owned purely for leverage to rising silver prices, some of that thesis has already played out. In contrast, companies with improving operations, strategic acquisitions, or meaningful exploration upside retain value independent of short-term price fluctuations in the metal itself. This framework becomes especially important when considering supply dynamics. Despite rising prices, silver production is not easily expandable. The majority of global silver supply does not come from primary silver mines, but from byproduct production tied to copper, lead, zinc, and gold mining. When base metal production slows due to declining ore grades, political constraints, or capital underinvestment, silver supply tightens regardless of silver prices. This structural reality places a natural floor under the long-term silver market, even when near-term charts suggest a pause. Let's get back to Rick Rule's interview.
Macro thoughts on oil?
The most important macro thought on the supply side is underinvestment in sustaining capital of between $1 and $2 billion a day. Producers around the world are not investing enough money in the oil production to maintain production 2 or 3 years out. At $60 oil, and we're not at 60, we're below that, the United States has drilled through apparently 85% of its tier 1 drilling locations using current technology. So at this oil price, I think it's fair to say that U.S. production has plateaued. And it was the U.S. that was the difference between supply and demand. The Saudis have done a very good job of maintaining sustaining capital investments. And it would appear now that the Saudis have between 800,000 and 1 million barrels of surplus producing capacity, which they could increase. But you have structural declines in Mexico and Venezuela in particular, where declining sustaining capital investments have reduced their ability to produce. You also have what would appear to be systemic production declines in the British part of the North Sea sector, again, politically induced. The wild card, of course, would be any peace announcement in Ukraine. If the Russians were permitted back into Western markets, while it might not impact oil markets immediately because the Russians have deferred sustaining capital investments too, they will be slower to ramp up than people think, it would immediately impact European natural gas markets. The ability of Russian natural gas to back out some LNG that's currently being shipped into European markets would impact global markets. But I suspect the real story that you're seeing in that price deterioration has much less to do with supply and much more to do with weakened demand. Weakened demand, particularly in growth markets, or what were growth markets, and in continental Europe, where I think the economy is much weaker than people think it is. That chart tells me that you are seeing demand hiatus in continental Europe, and you're also seeing demand hiatus in China.
I'm less inclined to believe that the unrest in Venezuela has anything to do with drugs, and more inclined to believe that it has more to do with oil. What are your thoughts?
I think that's correct. If Mr. Trump wanted to solve the drug problem in the United States, he could begin six blocks from the White House. These people don't ship drugs into a vacuum. The right place to enforce drug laws on a global basis is the United States. That's politically very unpopular. I think the United States probably would like to influence the political will of Venezuela. Many people don't know this, but Venezuela has the largest probable reserves of any region in the world, including Saudi Arabia. The problem is that the Saudi crude is medium or light crude, and the Venezuelan crude is extremely heavy, extremely high sulfur crude. In order to upgrade, well, there's two kinds of crude in Venezuela. The Maracaibo crude, their traditional crude, is nice, light, sweet crude, but they don't have much of it left, and they haven't made sustaining capital investments. The Orinoco crude is a heavy sour crude. And that's going to require real investment in beneficiation. Sidebar, the right way to do it would be to build 2 or 3 nuclear power plants on top of it to back natural gas out of Venezuela's power generation, and to use the waste heat from the nuclear power plants to generate some of the steam to liberate that oil, and use the low-cost energy generated to move that. After the application of nuclear power in the Canadian tar sands, where it ought to happen, probably the best return on capital employed investment that the oil industry could make worldwide would be the establishment of nuclear capacity on top of the Orinoco oil sands. But we can have that discussion another time. That's just a Rick techno fantasy. But people don't understand, I think, the fact that Venezuela has more reserves, probable reserves, than any other country on the planet. They don't have the technological sophistication, the capital, or frankly, the political will to turn those probable reserves into current production yet. But I think Washington looks at that. Remember, too, that the U.S. Gulf Coast refining industry over 20 years debottlenecked capacity by shifting their process expertise from stuff like West Texas Intermediate to Mexican and Venezuelan heavy sour crude. And ironically, we went for a cheaper, less premium, easy to access commodity to one where we have production shortfalls. Now, we could solve that. We could debottleneck the Keystone Pipeline and move those heavy sour Canadian crudes south, displacing Venezuelan oil with Canadian oil. But Mr. Trump seems to believe the Canadians are enemies too.
Taken together, rules analysis reinforces a broader truth about precious metals bull markets. They unfold over years, not months, and they reward patience far more than prediction. Silver's recent run fits well within historical patterns, where enthusiasm accelerates before the market pauses to digest gains. These pauses are not failures of the bull market, but mechanisms that prevent it from ending prematurely. Investors who mistake consolidation for collapse often exit just as the long-term opportunity matures. At the same time, the gold market remains a stabilizing force beneath the surface. Gold tends to reassert leadership during periods of uncertainty, particularly when financial stress, currency debasement, or geopolitical instability re-emerge. The interplay between gold and silver leadership should be viewed as complementary rather than competitive. Each metal serves a different role in a well-constructed portfolio, and shifts in leadership often signal changes in investor composition rather than changes in underlying fundamentals. Rules discussion of oil adds another crucial dimension to this analysis. Chronic underinvestment in energy infrastructure, declining production capacity in key regions, and politically driven supply constraints create long-term vulnerabilities that markets cannot simply wish away. While short-term oil prices may fluctuate with economic sentiment, the structural supply picture remains tight. Geopolitical tensions, particularly involving energy-rich nations, should be understood less as isolated events and more as symptoms of deeper resource competition. When energy markets, precious metals, and geopolitics are viewed together, a coherent picture emerges. Capital scarcity, declining real investment, and political interference are shaping a world where tangible assets regain strategic importance. Gold and silver are not reacting to a single crisis. They are responding to a gradual erosion of confidence in financial stability, energy security, and long-term policy credibility. For investors willing to think beyond quarterly price moves, this environment presents opportunity rather than risk. The challenge is not predicting the next dollar move in silver, but maintaining disciplined exposure through inevitable pauses while focusing on quality, valuation, and supply realities. Rick Rule's framework offers a grounded way to navigate this cycle without losing sight of the bigger picture. Thank you for watching. If you found this analysis valuable, please like the video, share it with others who follow the metals and energy markets, and subscribe for more in-depth discussions with some of the most experienced voices in global resource investing. Your support helps keep this channel focused on substance over noise.